The CEO of the most hyped tech company on Earth just admitted something that should terrify every investor on Wall Street. His $200 per month subscription service loses money on every single customer. Not a little money. Not breaking even with future growth potential. It actively loses money with each sale. And Wall Street's response to this confession. They valued his company at $500 billion. Welcome to the AI bubble, where we went from a cool chatbot novelty to a $7 trillion gamble in just 24 months, and why the people writing the checks might be in for the rudest awakening since the financial crisis of 2008. November 30th, 2022. Just a regular Wednesday. Nothing particularly special about it. Unremarkable cold brew coffee flowing through office buildings. Engineers debugging code like they do every other day. Then OpenAI dropped ChatGPT on an unsuspecting world. Within 48 hours, the internet had a new obsession that consumed everything. People were using it to write breakup texts, debug complex code, explain black holes in simple terms, and generate personalized bedtime stories for their children. Parents were calling their friends in amazement, telling them their kids were talking to an AI that seemingly knew everything and could explain quantum entanglement using Minecraft terminology. ChatGPT hit 1 million users in the first 5 days after launch. 2 months later, 100 million users. It became the fastest-growing application in history by an absolutely staggering margin. Instagram took 2.5 years to hit 100 million users. Facebook took 4.5 years. ChatGPT accomplished the same milestone in just 60 days, and Silicon Valley went into absolute panic mode. Inside Google's headquarters, executives were having a complete meltdown. They invented this technology. The transformer model that powers modern AI was their creation. The seminal research paper had their names on it. They had pioneered the fundamental architecture. So why was everyone's son and daughter using ChatGPT and not Google AI? Because Google had been too scared to release it to the public. They were terrified of what their AI might say, of potential lawsuits, of bad press and public relations disasters. OpenAI had no such fears. They shipped first, consequences be damned. And in technology, first-mover advantage is absolutely everything. Within weeks of ChatGPT's explosive launch, Microsoft threw $10 billion at OpenAI with another $3 billion on standby for future investments. Google panic-launched Bard in response, which immediately hallucinated false information in its very first public demonstration, creating exactly the kind of embarrassing situation Google had been trying to avoid. Amazon started dumping billions into Anthropic, OpenAI's main competitor. Every tech company suddenly needed an AI strategy, or they risked being left behind in what looked like the next great technological revolution. The venture capital frenzy reached absurd levels. Companies would walk into pitch meetings and say they were a dog-walking app, but their route optimization uses machine learning. Investors would interrupt them before they could even finish their demo and throw $50 million at them. Don't you want to see our product demonstration? Shut up and take my money. By mid-2023, if your slide deck mentioned neural networks or large language models, you were basically printing money. Companies with zero revenue, no actual product, just a team, and a Google document describing their vision were raising $100 million funding rounds. The bubble gave us technological marvels like AI-powered toothbrushes that supposedly cleaned better, AI recipe generators that created meals from whatever ingredients you had, and AI dating coaches that promised to improve your love life. One company raised $30 million to build an AI system that summarizes the outputs of other AI systems. We had reached peak absurdity in the hype cycle, but the real insanity manifested in the GPU shortage. These little computer chips that look like harmless circuit boards became more valuable than gold or oil in global markets. Nvidia, the primary manufacturer of these chips, became one of the most valuable companies on Earth practically overnight. Their CEO Jensen Huang started wearing leather jackets to technology conferences like he was Mick Jagger of semiconductors, and in a very real sense, he was. Renting a single top-tier H100 GPU costs about $3 per hour, which sounds relatively cheap until you understand the scale involved. Startups don't need just one GPU. They need hundreds or thousands running simultaneously. A small startup trying to train just one AI model might rent a 500-chip cluster. It's $1,500 per hour, $36,000 per day, over $1.1 million per month, just for renting GPU computing power, not including any other operational costs. Yet companies were still hoarding GPUs like doomsday preppers, stockpile canned beans, and bottled water. Nvidia couldn't manufacture them fast enough to meet demand. The waiting list was at one point up to 12 months long. Black markets emerged for GPU access. People were literally smuggling high-end graphics cards across international borders like contraband. By 2024, everything became AI-powered, at least in marketing materials. Your toaster burns bread with 10% more efficiency using AI. Your calendar app suggests meeting times using machine learning algorithms. Your grocery store self-checkout system is just a camera, but now the company calls it AI-powered computer vision. The party was in full swing. Champagne was flowing, investment checks were clearing, valuations were soaring. Then somebody finally asked the uncomfortable question that everyone had been avoiding. How much does this actually cost to operate? January 2025. Sam Altman, CEO of OpenAI and the public face of the entire AI revolution, tweeted something that made every investor's blood pressure spike dangerously. He wrote, "Insane thing. We are currently losing money on OpenAI Pro subscriptions. People use it much more than we expected." You heard that correctly. OpenAI charges $200 per month for their professional tier subscription, and they lose money on every single subscriber. Which means the more successful they become at attracting customers, the more money they lose. This is not a sustainable business model by any definition. When they launched ChatGPT Plus at $20 per month, their entire pricing strategy was astonishingly unsophisticated. They tested two price points, $20 and $42, to see which one generated fewer customer complaints. Then they picked that price. No comprehensive market research, no detailed cost analysis, no financial modeling. Just vibes and gut instinct. That's how a company valued at $500 billion priced its flagship consumer product, based on vibes. But the situation gets significantly worse when you examine the full financial picture. OpenAI's 2024 finances show revenue of $3.7 billion against losses of $5 billion. They didn't just fail to generate a profit, they lost substantially more money than they made. This isn't a narrow miss on profitability. This is burning cash at an alarming rate. Now here's where the numbers become truly insane and almost incomprehensible. Industry forecasts show that AI infrastructure will require $6.7 trillion in total investment by 2030. Let me break down this astronomical figure. $5.2 trillion will go directly to AI infrastructure, including GPUs, specialized accelerators, massive power grid upgrades, industrial cooling systems, and data center construction across the globe. The remaining $1.5 trillion goes to traditional non-AI cloud infrastructure to support the ecosystem. The four largest tech companies alone are expected to spend $350 billion in 2025. That's 1 year of spending, not over a decade, not amortized across multiple years. $350 billion in a single year. And here's the kicker that should terrify anyone paying attention. To justify these costs and provide returns to investors, the AI industry needs to generate $2 trillion in annual revenue by 2030. Current total AI revenues across the entire industry are somewhere around $200 billion. That's a 10 times gap between current reality and required future performance. OpenAI's internal projections are even more aggressive and potentially delusional. Sam Altman is proposing they hit $100 billion in annual revenue by 2029. That's not a trajectory based on historical growth patterns. That's a hockey stick curve drawn by someone who's never played hockey. To even attempt reaching this target requires $115 billion in cash burn by 2029. When executives ask when the company becomes profitable, Altman's answer is 2029, maybe 2030, or possibly 2031. And if revenue doesn't hit $100 billion, if this hockey stick projection snaps in half, the plan is simply to raise more money. From whom exactly? Microsoft? Saudi sovereign wealth funds? An extremely optimistic pension fund manager? Since 2021, private investors have pumped hundreds of billions of dollars into AI startups and companies. Most of that capital went to just 10 companies whose combined valuations swelled by nearly $1 trillion. Everyone is betting they'll become the next Google, the next generational technology company. Then the failures started rolling in and accumulating. ChatGPT and other AI systems started hallucinating, which is tech industry speak, for completely making things up with absolute confidence. These systems cited research papers that don't exist, referenced legal cases that never happened, and generated statistics from what appeared to be an alternate dimension. Google's AI famously told users to put glue on pizza to make cheese stick better. It learned this helpful tip from a Reddit joke that it interpreted as legitimate advice. Yes, this actually happened in a public demonstration. The lawsuits arrived next in waves. Artists, writers, musicians, and journalists all started asking the same fundamental question. Did you train your AI on my copyrighted work without permission or compensation? The answer from AI companies was essentially yes, but we prefer to frame it differently. The New York Times sued OpenAI. Getty Images sued Stability AI. Authors sued everyone. Musicians sued everyone else. The AI companies' defense was that they didn't steal content. They merely learned from publicly available data. The plaintiff's response was that these companies scraped the entire internet without permission and used it commercially for profit. When you phrase it like that, it sounds distinctly illegal. By mid-2024, the cracks in the AI narrative were showing clearly. The vibe shifted from euphoria and unlimited optimism to something more dangerous and uncomfortable. Doubt began creeping in. The hype had been incredibly loud and all-consuming. The mathematics were ugly and didn't support the valuations. And now everyone had the same uncomfortable question buzzing in their heads like a mosquito at 3 a.m. When does this whole thing explode? This looks exactly like a bubble. The losses are insane. The valuations are completely delusional. Company fundamentals don't support these prices. But here's what makes this bubble different and potentially more dangerous. This bubble isn't popping the same way the dot-com bubble did in 2000. Why not? Because the people inflating this bubble are also the people with the biggest wallets on Earth. And they have essentially unlimited resources to keep the game going. Unlike 1999, when startups had 0 revenue and 17 foosball tables but no business model, today's AI bubble is being funded by big tech companies that actually make real money, enormous amounts of real money. Enough money to buy an entire country if they felt bored. Microsoft prints billions from Azure cloud services. Google prints billions from advertising. Meta prints billions from showing you memes your cousin already sent you on WhatsApp. These giants aren't investing in AI because it's currently profitable or because the return on investment makes sense. They're investing because they're absolutely terrified of being the company that didn't invest enough and got left behind. If AI becomes the next iPhone moment, the next Google search moment, the next entire world changes overnight moment, then the company that slowed down or hesitated becomes BlackBerry. And nobody wants to be BlackBerry, a cautionary tale of missed technological transitions. Think of big tech companies like poker players who all brought unlimited chips to the table. If Microsoft folds their hand, Google wins the pot. If Google folds, Amazon wins. If Amazon folds, Meta wins. No player can afford to fold because doing so means conceding the entire future of technology to their competitors. No one blinks. No one folds. Everyone keeps raising the stakes higher and higher. The pot grows to absurd levels, but the game continues. That brings us to the real, uncomfortable question. If everyone keeps spending, regardless of returns, how do bubbles ever actually pop? The short answer is they burst when a real-world event forces everyone to stop pretending the fundamentals don't matter. Historically, that triggering event usually comes in 3 forms. First, the money suddenly disappears. The dot-com bubble didn't collapse because websites were stupid or technology was worthless. It collapsed because the cash spigot shut off abruptly. Interest rates rose. Borrowing got expensive. Funding vanished. And thousands of companies evaporated overnight. If interest rates rise significantly anytime soon and big tech companies are forced to tighten their budgets, the AI bubble ends instantly. Second, a big embarrassing meltdown happens that destroys confidence. Every bubble has its defining moment, One spectacular failure that freaks everyone out and triggers mass panic. The dot-com era had massive earnings disasters. 2008 had Lehman Brothers, crypto had FTX. AI's version could be a giant lab revealing massive unexpected losses, a catastrophically botched model launch that causes real harm, or a lawsuit that freezes development across the industry. Third, and most dangerously, reality slowly grinds down expectations. Revenue targets get missed repeatedly. Costs keep rising without corresponding increases in value. Customers stop paying premium prices. The promised revolution fails to materialize in ways that create actual economic value. This is the slow deflation rather than the sudden pop. So where are we right now in this bubble cycle? Big tech is still spending at record levels. There has been no meltdown earnings call yet that triggers panic. No FTX-level scandal has emerged to destroy confidence. Reality is showing cracks and problems, but not enough to break the collective faith in AI's transformative potential. Yes, this bubble is inflated to dangerous levels. Yes, the numbers are absolutely insane and don't make traditional business sense, but it won't burst simply because of hype or high valuations. It bursts when one of the giants finally says enough is enough and stops spending. When Microsoft or Google or Amazon looks at their returns and decides they can't justify continued investment at these levels. When shareholders demand profitability instead of growth at any cost. When the fear of being left behind is finally outweighed by the fear of losing hundreds of billions on a bet that didn't pay off. Until that moment arrives, the bubble floats. We're not at the explosion yet. We're at the tightening, the tension building to unbearable levels. The inhale before the scream, the pressure before the snap. The episode right before the season finale, when you know something massive is about to happen. But you can't quite predict how it will unfold. The AI bubble is real, it's enormous, and eventually it will face a reckoning with economic reality. The only question is when, and how much damage it will cause when it finally pops. Do you think the AI bubble will burst like .com? Or is this different because big tech has unlimited money? Are we witnessing the future or the biggest financial disaster of our generation? Share your predictions in the comments, subscribe for more analysis on the AI economy, and let's track this bubble together as it inflates or explodes.